Hi traders, welcome to Market Outlook, Trends, Risk Events and Trade Setups, brought to you by Vantage Markets. This is a weekly webinar where we focus on the key events and themes, both technical and fundamental, driving the markets at the moment. Whilst I just let you have a brief look at the disclaimer even, I'll just run through what we hope to get through in the next 40 minutes or so. A packed webinar, actually, lots of things going on, of course, even with this shortened week really in markets because of the US holiday tomorrow, July the 4th. Our goal really just to break down all the market jargon and complexities that we read about. So if you do have any questions, please do ask them along the way in the Q&A box, actually, and hopefully I'll get to those during the webinar or definitely afterwards, and we'll try and break down, as I say, some of the questions you have or some of the trade setups you're looking at, and hopefully we can offer some advice on that. First of all, we will just focus on follow the standard format actually of the webinar. So we'll look at some of the last week's main risk events, primarily the Eurozone CPI data, and also a brief look at the core PCE US data from last week. We'll check in with some of the central bankers at the ECB conference at Sintra in Portugal, just run through briefly what they mentioned, and then we'll get on to the main events of this week. A packed week, as I say. We have the RBA meeting, we have a load of US data, important US data, top tier non-farm payroll figures on Friday, of course, as well as some survey data. The ISM manufacturing and the services data will be important for markets in the run-up to the end of July's FOMC meeting. Before we get to that as well, we'll just look at, as I say, a brief rundown of how markets are shaping up this week. As I say, a short but critical week really ahead in markets before the US holiday, as I said, which sort of kicks off then potentially a sort of summer lull really, which will possibly keep volatility at bay. Summer lull, though, of course, means that liquidity volumes are lower in these next few weeks, with traders at investment banks, at hedge funds away from their desks for holidays. So liquidity is thinner, so we could actually get sharper moves. Depends really what comes up in the data, as certainly central bankers are highly data dependent at the moment. For this week anyway, we should start quite quietly. We're picking up really. There's a little bit of dollar strength, just looking at the markets there. Gold is sold off and stocks generally in the green. Independence Day, as I say, is tomorrow. That means US markets certainly will have reduced flows probably today until after tomorrow. Then we pick up with a load of US data activity, as I said. And then potentially that affects markets, which are increasingly of the view in the US that we see a July rate hike of 25 basis points. That now appears to be consensus view. If you remember, after the dot plot, recent dot plot by the Fed, of course, where they signposted 2 more additional rate hikes, the market wasn't convinced, but now that appears to be consensus view. On the macro front, then, as I mentioned, packed, we get US labor market indicators, non-farm payrolls, of course, but we also get those ISM surveys, which should really give a fresh test of the US's economy and its health, especially on the services side, which is out on Thursday. As I said, RBA decision, that will be a close one. And then we also get potentially German data and potentially recession concerns deepening going forward. Oil markets have been in focus a bit this morning on the production cut by Russia, which comes into effect next month. And there's also some focus on Saudi production cuts, which take hold, I believe, this month. As for today, in the immediate future, then we do get all eyes on the ISM Manufacturing Index survey data out of the US, ahead of then more data out through the week. I just want to focus on stocks first of all. That's what we normally do. European stocks at the moment, following Asia higher actually after better than expected data from China, eased really investors' nerves over the sluggish post-pandemic recovery in the world's second largest economy. European indices lifted actually by strong performance energy, basic material stocks. As I said, investors taking heart slightly from signs of resilience in factory activity data out of China. The Caixin Manufacturing PMI survey released earlier today fell to 50.5, but it was above the consensus 50.2 polled by Reuters. That boosted really Asian blue chip indices. The Hang Seng was up 2.4%. China's CSI 300 up over 1%. And the topics in Japan that added 1.4%. The data comes after, of course, the PBOX last month's cut in its benchmark lender rate for the first time in almost a year. Policymakers really extending that cautious monetary support in an effort to spur more robust growth in China. Certainly adding to the momentum though, late on Friday, the NASDAQ. So we have a chart here, bar chart here, you can see quite clearly. But the NASDAQ, yeah, really interesting, obviously finishing off June strongly, up on Friday, just checking, up 1.6%. That's 1.6%. That's the Nasdaq Composite. So it recorded its best first half of the year since 1983. 32% gain, powered by a handful of large tech stocks, and of course the potential growth of artificial intelligence, AI. Really for any half actually, so the first or a second half, the Nasdaq recorded its strongest performance since the peak of the dot-com bubble in the second half of 1999. The biggest contributors to the rally, certainly those big mega cap tech stocks. We've been talking about this for a number of weeks now, just simply the breadth and the narrow breadth of the leadership of the US indices. For sure. I know they're now called the Magnificent Seven, these big tech companies. So that is Apple, Amazon, Microsoft, Nvidia, Alphabet, Meta, and Tesla. So those are the Magnificent Seven, if you like. And Apple, I'm sure you know, on Friday hit a new record high, valuing the company at more than $3 trillion. While, of course, chipmaker Nvidia being in the news over the last several months, tripled in value, in price since the start of the year. So here you can just see a bar chart going back those sort of 40 years and this really strong performance that we've seen in the first 6 months of this year. Then if we move to this other chart, courtesy of the FT, you can see in Bloomberg. So this is just rebasing the major indices out in the US, of course, and also the broader European index, the Eurostoxx Europe 600. You can see they've rebased those to 100 on this chart, rebased, and you can see that outperformance of the Nasdaq Composite over then the broader, the benchmark blue chip S&P 500, and then the lighter blue line, the Eurostoxx 600. So you can see really Nasdaq, yeah, risen twice as much as the pretty strong 16%, 16 that is, percent in the broader S&P 500 since the start of the year, really highlighting the effect of those mega cap tech stocks. If all the stocks in the S&P 500, we've actually talked about this before, of course, were equally weighted, the S&P 500 would only actually be up around 5.5%. So much more modest gains for this year if all the stocks were equally weighted. Of course, they're not. So priority given to bigger mega cap stocks with bigger weightings given to market cap, in particular in the S&P 500. But certainly aside from that, then we've had clearer messaging from central banks plus, of course, easing inflation. And that's supportive of stocks, supportive of tech stocks especially. Although, as we've said, the Magnificent Seven, if you like, have been the key driver. Going forward then, I guess the risk is the Fed's ongoing battle with inflation. We'll touch upon this going forward in the webinar, actually, which then, of course, this battle with inflation means potentially higher rates, which then push the economy possibly into recession. But it's really interesting. Over the last few months, we've talked about hard landings. We've talked about soft landings. And sort of even now, we're talking potentially consensus possibly going to the view that we don't get any sort of bad landing, if you like, because the economy is still powering along in certain areas and still doing quite well. Of course, the base case of the Fed previously was some kind of slowdown, and we have to remember that that raising interest rates, the idea of that, of course, is to slow demand and slow the economy. That is a fine line, and we keep going back in some of our daily commentary to the fact that it's very tough to thread this needle, if you like, to bring the economy back, rein the economy in without causing some sort of slowdown. So certainly then sort of equity performance has been quite unusual, slightly out of whack with potentially this slowdown. But of course, the slowdown or a reversal is not inevitable for sure. And certainly then the AI enthusiasm, if you like, kind of seems more genuine, doesn't it, than other sort of hypes that we have seen in the last few years, especially like the metaverse or like VR. And earnings growth is feeding through. So that's something to bear in mind, we would say. Just on then the technicals, those are some of the fundamentals that we've seen and potentially things to look out for going forward. This is the NASDAQ weekly chart. We like to sort of bounce out to a wider time frame really to start. And you can see, well, I have the Keltner channels in here. Some of you might use Bollinger Bands, kind of similar, but they rely on standard deviations, whereas Keltner channels rely on or represent really volatility using high and low prices. They're kind of based on the average true range, and that projects then the true width of the price range that we've seen. So just I thought I'd keep these in for this week on some of these equity indices anyway. And you can see if we just pull back, they're not always accurate, but they just give you, if you look at, say, other indicators, which I strongly recommend, you don't just use one indicator, but you use several. So here we've got the RSI, then you've got Keltner channels as well, Keltner bands, if you like, which are essentially, as I said, a set of bands placed above and below the current asset price. And they're a kind of volatility indicator using ATR, so using average true range and then using exponential moving averages. So you can see when we do touch some of these bands, it looks like potentially we're overbought on the top side then, and then we do get a pullback. But obviously this is the equity market, so it's been a strong ride, certainly when we go back even further, obviously, to 2019 and before that. So, but you can just see sometimes where we do touch the bands and then we're overbought. We do get pullbacks, and there are other measures that we can use to look at that where we get a deeper pullback, and then it just warns of potentially overbought or oversold territory, if you like, for some of the price action that we've seen. So again, leaving the Keltner channels in, you can see we're well out of those channels now, well out of the upper band, and we're overbought strongly in the RSI as well. But then we have had a pause in the in price action on the week 2 weeks ago, of course, and then obviously we've made new highs since that last week. If we go to the daily, you can see that nice healthy pullback, pulling us back towards the middle of the middle band, if you like, in the Keltner channel, back below 70 in the daily RSI, and then we moved higher again. So just sort of some indicators as to potentially some top side. We've got a long-term fib level in here. You can see of the sort of 2022 decline, and the next minor fib level really is 78.6 is at 15,411. So potentially that's an upsized target for the bulls that would take out the 15,284, of course, which we did take out. We didn't quite take out last week actually. So 15,284 on the upside, initial resistance, and then potentially for us 15,411 to look out for, 15,400 around number potentially further upside. Otherwise, if we do or slow down and we turn around, then potentially we've got probably the breakout level, which is that low from a few weeks ago at 14,571, and then probably 14,349 being a 61.8 fib level as probably more major support if we do turn around and turn lower. So that's the NASDAQ 100. For the S&P 500, then you can see just that healthy pause for us anyway. A couple of weeks ago, and then this push higher and a strong close. You can see close near the highs, so that really denotes strength to us. And then potentially you've got that 78.6 again, which would be around, where are we, 4,534 or so. So 4,534 next upside target, and then certainly you've got then a swing high around 4,637, which is the March 2022 high. Interesting levels. Otherwise, support below would be around 4,300, 4,311. You can see the 61.8 there. And then, of course, we've highlighted this over previous weeks. Hopefully, some of you were listening. I know, but that big break of that sort of 4,200 level, everybody was looking out for it, as well as us, tallied with this grey line, which was or is the 100 week moving average. That was at 4,200 or so. And then you had, of course, the January high, which is at 41.95. So that break above there after tracking sideways, we always say this, but if we track sideways, then generally we will have a big breakout, normally in line with the longer term trend. So that was pushing up to pushing the upside, and we did have that, and we've had decent upside since then. Okay, let's just quickly look at the Dow as well, which I'll just put up here. Sorry, let's just step back 1 second, just check the daily, but you can see, yeah, we challenged those recent highs at 44.48, and we've closed above that as well. So interesting whether we can stay above here and push higher to those levels we just talked about. Just on the the Dow, let's go to the weekly just to show you again the strong resistance level we've had for a number of months now at 34,281. You can see we closed above that at 34,467. So potentially really interesting if we can push above that now. This strong line of resistance, you can see the dotted line there. Let's just take out some of these. These are moving averages, but we've moved above the 100-day 100-week moving average at 33,581, but the big one for us, as I say, 34,281, and potentially if we can close up, we'll just move above that now this week, then you have a few levels here, 35,492 potentially, which is that April 2022 high for bulls to target to the upside before then possibly then moving up towards these highs back in sort of, where are we? Start of January last year, and then sort of December, November highs, sort of above 36,000 potentially. Otherwise, if we do roll over, that 34,281 does still act as resistance, and it'd be really interesting, as I say, price action around this level, because you can see we tried to break it a number of occasions across a number of weeks, and we sort of didn't, and we failed and we rolled over. So yeah, really interesting. Potentially then support 33,581 before, looks like the 50-week moving average, that blue line, could do a job as well at 32,909. Nearer term dailies, you can see the 50-day moving average at 33,624. Yeah, I probably stick to that. As you can see, it sort of held prices initially last week. That's in the Dow. Okay, moving on then, let's just go now to just a brief recap of some of the important data from last week. First of all, you can see this chart here, which is the Eurozone CPI, really important for the euro. This kind of data, obviously inflation data, it dropped. The headline anyway dropped from 6.1% in May to 5.5% in June. So the thick blue line is the headline rate, that dropping then to 5.5%. Food inflation moderated substantially, although there could be a seasonal adjustment, actually, according to some economists, which suggests possibly a monthly uptick between May and June. Still, the year-on-year headline inflation rate is coming down, and certainly energy inflation is strongly negative on base effects, which will affect this number going forward, as it will potentially in other countries, other regions for sure. The main focus for the ECB, though, is currently on core inflation. We've said this over a number of months. That's the orange line there, which is still sticky, still elevated, and that ticked back up actually from 5.3% to 5.4%. So that actually didn't cool down. I should really have changed that headline. But this was mainly due to the effect on services inflation from German government support last year. So potentially the trend is still elevated, as I say, still sticky, but potentially moving lower in the core, and we have potentially seen that peak. The issue is for policymakers, the labour market still remains hot. That's the key concern for the ECB. So while there are tentative signs of cooling, if you think of vacancy rates, they've moved past their peak. But unemployment remains stable, and that's kind of historic lows, 6.5% it was in May. So for the ECB, essentially, this means the risk of prolonged high wage growth remains in place. And that's really a key reason why the ECB is not pausing in its hiking cycle just yet. As well, if we look at other forward-looking indicators for inflation going forward, they're kind of looking slightly more benign, though, with selling price expectations steadily dropping by the month. That will be interesting for policymakers. And then we also have a slightly more sluggish economic environment, which is potentially also adding little demand pressure. I think interestingly then, if we think back then as well to what policymakers have said recently at the ECB, an improving inflation environment will be encouraging for them, but then it's pretty clear from what policymakers have said recently, there is still more work to be done. And the ECB, really, they think it's more costly to do too little in terms of rate hikes than do too much, which means that markets expect the ECB to continue hiking with probably two final hikes, one this month and then one in September. And then by then, probably the blurring base effects, if you like, from government support should largely have faded. So base effects, you remember, we just look back 12 months when we had the inflation spike. And then if we compare that moving forward 12 months ahead, then if some of these support measures will have dropped out of those year ago readings, then we will get a blurring effect, as I say. That potentially then means a pause becomes more likely by the ECB. Moving forward, in fact, just before I move forward for the Eurozone anyway, I don't want to get too technical on some of these charts because there's so many charts out there, but this is an interesting one, I thought. So the orange line is Eurozone CPI data there. You can see it's falling, the headline, as we mentioned, and dipped, of course, below 6% in June to 5.5%. But then you have this, it's basically PMI input prices, which kind of leads, potentially you can see nicely leads that headline CPI data, by 6 months or so, and potentially then we could see that headline figure dropping to around 2% by the end of this year. So just an interesting chart, just bear that in mind, certainly on the headlines front, and then whether core eventually follows that will be key for the ECB and obviously for potentially the euro. As I said, for this week, then moving forward, it's a relatively quiet week in Europe anyway. We get retail sales Thursday, kind of not that important really for the Eurozone. Future prices Wednesday. But investors will be keeping an eye on potential revisions to the June PMIs when the final prints are released. Actually, some of them today, actually, we might have seen, which I'll need to check. And then also Wednesday. They weren't very encouraging, certainly, and they raised question marks really about how much longer the Eurozone can remain resilient, certainly in the face of course, the rising interest rates that we've seen, and then also China being a major issue with the sluggish export markets out of the Eurozone. That means, of course, Germany will be in focus and potentially the slowdown that we've seen there are getting data showing a slowdown. And potentially then Europe's largest economy is already in a recession and the outlook is not that bright either. That said, well, not really that said, but the ECB, as we know, determined to squash inflation really with more rate increases. And so will be interesting, possibly, if you like, looking at some of the German data, especially we get industrial orders Thursday, industrial production Friday, all for May, which will be seriously looked at by the markets because of this concern around the German slowdown. ECB speakers, there are some actually this week, but they probably won't have a big, strong impact on the euro, even though markets will be interested in comments following, of course, the inflation report we just talked about. Of course, we had Sintra, that's ECB symposium last week, and we'll just touch on that shortly. And we have touched on it already, but we've heard from many ECB members clarifying their rhetoric already. So in a way, for Eurodollar anyway, it seems potentially likely that the dollar side will be driving that pair really this week, especially with, well, once all the US data starts to come in. If we just look at then Eurodollar technicals anyway, we can see, we'll just go to, yeah, the weekly chart again. We've got this long-term sort of level in here above at 110.32. That's key for us. You can see it sort of capped the upside over sort of April, May time, and then we fell back below that. So that's a key level for us on the upside, 110.32. We got a few weeks ago towards that 110.12, and then sort of tracking sideways, really. You can see last week, if I blow this up, you can see that doji candle really last week. So prices settling in the middle of the high and the middle of the low, and opening and closing pretty much on the same level there. So where were we? 109.04 we opened and we closed at 109.09. So the high and the low last week, 109.76 and 108.35. So pretty much in the middle-ish, but a doji candle kind of signaling indecision really, but really that potentially could be seen as bullish consolidation if we can push above probably that high. So that would be initial support then, resistance 109.76, before then 110.12, and then 110.32 is a key level for us on the upside. Downside, so support probably around the lows you can see from last week, so 109.09 and then 108.91, and then you've got that 100-week moving average, but probably near term, yeah, the 100, where you've got the 50-day moving average 108.67, and then below that 108.19. So that is Eurodollar. As I said, we did have other inflation data. That was the US core PCE figures. They came in a touch beneath the expected at 4.6%. Yeah, 4.6%. Cooling from last month's 4.7%. All other measures, though, pretty much in line with expectations. Core up 0.3%, headline up 3.8% year on year, 0.1% month on month, kind of spurred relief really in markets that key inflation metrics continue to cool. It was actually the slowest rate of core PCE inflation in the US since October 2021. So certainly signs there. Although, of course, there are as well concerns around the tight labor market, which kind of continue to underpin risks going forward. I should say, though, we were encouraged by the sort of 0.1% month on month print. Generally, economists reckon we need 0.1 to 0.2% month on month prints over a series of months to get inflation down to the target of 2% year on year over time. So something to bear in mind there. Otherwise, data releases in the US last week were really surprised to the upside, really. Durable goods, if you remember, that rose in May despite expectations for a drop. We also had higher home sales. We have better consumer confidence, actually the highest reading since January 2022. And then we also had, well, backward-looking Q1 GDP data, which was revised up surprisingly sharply, actually. So really interesting to see all that data surprising really to the upside. And that's really pushing the Fed potential for rate hikes higher. I'm just thinking, should we go to that, or we'll just go firstly before we get to that, and the CME Fed Watch tool, which we like to look at, which really shows us what markets are thinking about the Fed. We'll just very briefly touch on Sintra, as I said last week, before getting on to this week. Gathering of the great and good in central banks. So we had obviously Fed Chair Powell, we had Bank of England Governor Bailey, we also had the Bank of Japan Governor Ueda, and then of course we had President Lagarde from the ECB. Hawkish side sort of taken by Powell, really. That was what markets took from it. It was sort of both sides really from him, but markets focused on really the fact that he said he wouldn't take the would not take the possibility of moving at consecutive meetings off the table. When he pushed on whether the Fed is now in an every other meeting hiking path. So that was pretty much the key takeaway really from what Powell said. Otherwise, his commentary is pretty much broadly in line with what he had been saying in recent weeks. Bailey, he also gave little away in terms of policy outlook, really referring back to the line that the Bank of England would do what is necessary to get inflation back to target. And then Ueda spoke on yen price action, actually saying many factors influence it, and an intervention is in the jurisdiction anyway of the government, so the Ministry of Finance. We've touched on Lagarde basically saying, stressing that the bank is data dependent. The base look, if it still stands going forward, then the ECB will likely hike again in July, and then September will be data dependent. This is a DXY chart. Before we actually look at that, I just want to touch then on what is going forward. If you can see, hopefully, this graphic, which is new for this week and looks like is probably slightly outsized. So I'll take that on board going forward. But you can just see the major data points through the next 5 days, of course. US data really dominating for us. So we get that manufacturing ISM survey data today in a few hours. Then the services on Thursday. We also get the Fed minutes on Wednesday before obviously non-farm payrolls. So yes, just moving on then to this week, ISM manufacturing expected to rise, but still below 50, the level that denotes contraction and expansion. The gauge manufacturing expected to rise to 47.2 in June, 47.1, sorry, from 46.9 in May. However, looking at the S&P Global PMI series for comparison, manufacturing companies experienced a contraction in production in the month. So that's something to bear in mind with this data. Today, new orders for manufacturers also saw a sharp drop, reflecting weak customer confidence and destocking by clients. So the outlook really for manufacturers is clouded by concerns over inflation and lower sales, and that's reflected actually in confidence falling to a 6-month low within the S&P PMI data. So something to bear in mind for the data today. Then we get probably more interesting will potentially be the services data, as I said, on Thursday. That is seen improving slightly in June. Consensus looking for a rise from 50.3 potentially to above 51 potentially. The outlook for services, the sector seems brighter than manufacturing because it's certainly above that 50 level, as we said. But that softer reading, as you can see here, has only been seen during the pandemic, that reading. So services, that's the worry that that's getting weaker and sort of possibly moves towards 50 at some point. As I said, the question, yes, certainly remains as to how resilient is the service sector going forward due to this decline in manufacturing, and then the lagged effect of certainly all of these prior interest rate hikes that we've seen. If we do get a deterioration in these ISM surveys in June, then that potentially could revive those recession fears after Powell certainly played down the prospect in that panel discussion last week in Portugal at Sintra. We also get FOMC minutes as well. The focus will be on, as I've said here, the skip decision, how much consensus opinion was around that skip, if you like. Of course, we had the interest rate dot plot that was revised by 50 basis points, taking the median rate to 5.6% from 5.1%, so indicating 2 further 25 basis point rate hikes. Important for us was that Powell cautioned at the Fed meeting that reducing inflation may require below trend growth and labor market adjustments. We're not seeing those yet, certainly in the labor market, but of course, non-farm payroll will be a key focus. But then Powell, of course, emphasized the need for a more moderate pace of tightening, and that rate cuts were very, very unlikely. Minutes may be slightly outdated because of Sintra, of course, and Powell has reiterated actually since then that it would be appropriate to lift rates at least a couple of times in keeping with the Fed's forecast, but certainly stating that incoming data will be the influencing factor. Then we get on to non-farm payroll. So hope you like this graphic. It's got all the major numbers of what is expected. If I just step back actually before focusing on some of these numbers, we do have the JOLTS, the vacancy data for May. That is on Wednesday, I think, and then the timelier, if you like, weekly initial jobs claim series, which is on Thursday. They will certainly shape sentiment on then the labor market, and then for the BLS employment report that we get, the non-farm payrolls report that we get on Friday. Just for the JOLTS then, that possibly is seen as slightly stale because the JOLTS data is actually for May, whereas non-farm payroll, the data will be through June. But certainly it can still be influential. Last month's data for April, for example, that saw an upside surprise, and that generated a modestly hawkish market reaction. For the weekly jobless claims, they receded in the latest week, although the 4-week average still remains close to the break-even level, which is around 265,000. So that's adding, well, will be important to note any sustained increase in the level of claims, as it would likely signal a deceleration, possibly in monthly job gains going forward. So as for the main report, the non-farm payrolls, here is, the main numbers, of course, as I've said, consensus looking for around 200,000, probably a touch more I've read, but that will change going forward, obviously, with the JOLTS data and the initial jobless claims. That was, of course, against a pretty blockbuster 339,000 previously. Then we get the unemployment rate, that's seen probably unchanged at 3.7%. And obviously ticking up from those multi-decade lows around 3.4% a couple of months ago. Average hourly earnings, always a key focus. That's seen rising, but matching the rise seen in May, around 0.3% month on month. Generally, though, US jobs market has been much more resilient this year than economists and analysts have been saying. Certainly, many have underestimated the headlines jobs figure. And as I've seen here, 14 straight beats. So over the last 14 months, the headline figure has beaten the estimates. And certainly this data will be a crucial factor in the Fed's deliberations when it meets much later this month, last week, I think, of the month, in July. Of course, any continued signs of labor market cooling from the data, it depends how big it is, but certainly probably won't be enough to keep the FOMC from restarting rate hikes in July. And sorry, just bear with me 1 second. If we do, then in July, if we then, sorry, bear with me 1 sec. I'm just checking out some price action here, but from restarting hikes in July. I was just going to move on actually to the dollar now, but just before we get there, just to show you the bar chart, nice bar chart here, just showing you, sort of slowing job gains, of course, from some of these big numbers, but certainly still solid. 200,000 job gains still solid when we're meant to be going into possibly a recession in other data. So in the employment data, it's certainly still strong, still healthy. With the jobless rate, you can see those multi-decade lows they are. Let's not forget that 3.4%. Even if we tick up to 3.7%, we're still very low in the jobless rate. And certainly many are expecting that to move up towards 4.5%. As the cycle progresses, as these interest rate hikes hit the economy going forward. I said we would just look at, some of the rate hike expectations very briefly. This is the Fed Funds CME Fed Watch tool. So this prices uses futures really to price the exact bets, if you like, which the market has through Fed Funds futures for the exact date for the Fed meeting. So as I say, 26th of July, end of July is the next meeting, then late September, start of November, mid-December, the last 4 meetings of this year. And you can see, as I mentioned, now an 89% chance of a 25 basis point hike by the Fed. And just look at how, even a month ago, we were a sort of coin toss chance, 53% of another rate hike. Now pretty much nailed on. Anything above 70, I always say, markets say generally the Fed doesn't want to really rock the boat, if you like, and not do what markets are pricing in generally. So above 70%, we're now 90 or so closing on. So that's nailed on for us. But then the interesting thing is, if you move to September, where obviously the Fed have said they expect 2 more rate hikes. So take out July as a given, then market's only given a sort of 22% chance of another 25 basis point hike. You can see that has doubled though from even a week ago, more than doubled, but still only a 21% chance. If we just move to November, I'll just check this. A bigger chance then, 36% or so, so above a 1 in 3% chance then that we do get this second rate hike at the November 1st Fed meeting. And if we just look below, you can see even a week ago, 16% chance and a 6% chance of that a month ago, going to sort of 5.5 to 5.75% for the Fed target range. So just interesting how the market has shifted. We mentioned that a few weeks ago. Again, we had that previously, where the Fed markets weren't listening to the Fed, but now they have once again. So interesting to make sure you understand that and appreciate that for price action, because then we can see Then the dollar, how that has affected the dollar last couple of weeks, where markets have started pricing that 25 basis point hike for sure, and then possibly another one as well. I think there's total a different slant on that would be, I think there's around 34 basis points or so, 35 basis points priced in total by the market, by the Fed, going forward in the next few meetings. And that has certainly supported the dollar. This is the DXY chart, which maps the dollar against its some of its biggest trading partners. Just remember that the euro accounts for around 56, 57% or so of this weighting in the DXY. So that's really something to bear in mind. But yes, so we've pushed higher in the DXY. We're now light blue line is above the 50-day moving average, so that's 102.81, and then the 100-day moving average, that grey line, we're just above that now. So potentially some support there around sort of 103, high 102s, if you like. We need to push above last week's high at 103.54 really to then get back to or get up to 104 area. Otherwise, if we lose support at that 102.81, then potentially we're moving down towards 102, where we do have strong support there. I didn't actually look at the euro. Yeah, we did look at the euro dollar, but that just sort of, you can see if you tipped the DXY on its head, that would be a similar type of chart-ish. So just if you didn't know that, then just bear that in mind, I guess. Okay, we are hopefully rattling on. Let's quickly go to the RBA. Don't see any questions. Please do ask any questions if you do have them along the way. Got another graphic here then with the RBA, and we'll look at the Aussie dollar very shortly, but these are the key numbers to know for us anyway. So just thinking about it, after back-to-back surprises actually from the RBA, the stage really set for quite a close decision. Certainly analysts, so economists who watch the RBA, it's kind of a coin flip again. 16 out of 31 economists surveyed by Reuters expect a 25 basis point hike, whereas 15 predict a pause at its current level of 4.1%. Money markets, they kind of think around 40% chance, slightly less now, I think probably this morning, towards 30% chance of a 25 basis point rate increase. And that means around sort of 60, 70% chance rates are kept unchanged. They do like to surprise though, as we said, 2 back-to-back surprises, the last 2 meetings. As a reminder then, yeah, they defied consensus last time for a pause in rates was expected. So 2 prior consecutive meetings, opted for 25 basis point increments. While certainly it noted at the June meeting that his actions were in response to elevated inflationary environments, and that data indicated that upside risk to an inflation outlook have increased. The statement remained kind of hawkish, largely reiterated the prior month's rhetoric, with the board remaining resolute in its determination to return inflation to target, and some further tightening of policy may be required. Interesting then, since then, the meetings, we've had subsequent comments by officials, initially kind of spurred some hawkish adjustments to rate forecasts. I think Goldman Sachs, they raised their peak rates view to 4.85% actually in September from a prior view of 4.35% in July. Another more local investment bank, they saw peak rates at 4.6% from 4.35%. So they saw back-to-back hikes again as well in July and August. However, yeah, the hawkish impetus kind of was nipped slightly in the bud, if you like, eventually unwound a couple of weeks later. From the minutes that we had, they revealed the board considered a rate rise of 25 basis points or holding steady, and that the arguments were certainly finely balanced. And then we have had that softer than expected monthly inflation data. I've got it in here, 5.6% against the expected 6.1%, and certainly was above the 6.8% previously. So that kind of adds to the case for the RBA to stand pat, if you like. But then Certainly that's far away still from the central bank's target. Remember, that is 2 to 3% a target range. And of course, the bank, as we said, likes to surprise. Again, flip side to that is certainly we've had strong jobs growth data. The May jobs growth, 76,000 job gains against 15,000 expected. And then the unemployment ticked lower actually, and still is very low. So really interesting decision potentially going forward, coming up actually overnight. And yeah, we've just got in there 4.1%, sort of 4.4%, I think now, and above that seen as the peak rate. Okay, just let's look at Aussie dollar then. Interesting. We've still got this sort of range in here. So the sort of top side and the bottom side sort of just below 66, and then the upside around 68. I know we peaked up below it and above it a couple of times, but we sort of couldn't sustain that really, could we? You can see there we're back in that range again over the last few months. Interesting really. I guess you play the range 66 or so potentially. We push above that, and we've got these moving averages you can see there which are converging now sort of around 67 or so. If we get above that, then we go towards 68. And you know probably how to play the ranges. The RSI you can see is around 50.45 or so. So that is the Aussie dollar. I've got a few fib levels in there, but yeah, the halfway point of the sort of this upside move from September up to the January highs, at least that is around, you can see where's the halfway point, 66.5 or so. So yeah, that is the Aussie dollar. I think we've spoken for quite a long time. It's great to see a lot of you still on here. Hopefully that's been of use. No questions as far as I can see. Please do follow us on social media, a number of channels, of course, and we do have daily commentary on the website, which just has a chart of the day as well as a sort of more in-depth look at the day ahead and just some market thoughts from us at Vantage. As I say, hopefully that's proved useful. We do have one quick question. Any gold predictions? Good point. Bear with me 1 second. I do like to cover gold, and we do cover that in the daily commentary on the website as well. So hopefully that will prove useful. But bear with me. I'll pull up a chart actually of gold. So 1 second. Bear with me 1 second. Yeah. So yeah. Well, we're looking at. We'll just look at the daily really, because we broke sort of that long-term trend line that you can see, and sort of we had a nice uptrend really, didn't we, from the 16-14 lows. We had this up sort of bullish channel, if you like, and if you didn't like the channel, then we had that nice rising trend line that you can see, which held prices back in where was it, back in, just bear with me 1 second, sorry. Yeah, around sort of 1837 or so, just below there, around sort of 1800. And then we've just broken out of that and broken down. So if we just go to the daily, you can see sort of tracking sideways, as we mentioned, the 100-day moving average, that is, acted as strong support around sort of 1940 or so, which was the lower end of this sort of sideways range. And then we've just broken below that. There was a false breakout, which got us interested, but then we've moved lower. So certainly 1940, 1944 will be strong resistance. And then potentially we're moving lower down towards, 1900 is a key level, a round number for sure. And then you've got the sort of fib level around just below 1900, so 1893. Certainly, though, prices, they did like, you can see on Friday, they like that softer PCE inflation data, which brought along, obviously, the weaker dollar and, of course, a general improvement in risk appetite. I think prior to that, it was sort of a battle, wasn't it, between bulls and bears. Around 1900, as I say, the previous day, which had left short sellers slightly bruised, again with that sort of move lower, and a failed attempt really to trigger really downward momentum. As I say, I think upside resistance around 1940, 1944, and then for the downside, potentially we need to break last week's low at 1893. Hopefully that's good for you. Sort of gold prediction. All depends certainly on the dollar for us, and then interest rates. In fact, if I just bear with me 1 second, I think really interesting to see. I don't like to go in the look at these too much because you can't really trade them on the retail side. But this is the 2-year Treasury yield. So this maps basically Fed funds essentially, and where interest rates are going in the US. And you can just see really interesting price action. We track sideways and then we've pushed higher over the last few days. And it looks like we're heading towards 5%. And these highs here, which if you remember, which were the pre-banking crisis highs. So interesting. We're getting up towards that 5% level. And in the 10-year, which is kind of a global proxy, if you like, for borrowing costs, you can see as well a breakout, but not so much. So I'd be careful here because potentially, yeah, we might get to 5%, but it's a serious level there if we can push above that. And if we can't, then those yields potentially then move lower, and potentially then we get a look at sort of 1944, and then we move back higher potentially. But don't hold me to that. Okay, one other question. Yeah, I'm pleased that's good for you, Martina. Sterling yen, yes. We've looked at this again in the daily commentary, so bear with me. I'll just pull up the chart, which has been very, very strong. Again, really interesting divergence, isn't it, between the uber dovish, if you like, Bank of Japan, and then a Bank of England, which is potentially hiking rates all the way up to potentially 6.25%. In fact, I had, if you bear with me 1 second, if I've got a chart here, which I have, hopefully. Bear with me 1 second. Yes, here. Hopefully you can see that. Yeah, you can see that. So excuse my scribbling before that. But you can just see essentially the reason for that massive, really strong uptrend, which I'll get back to in the sterling yen chart. You can see how now peak rates in the UK, 6.25% potentially. That's what markets are pricing in. That's why we've had a massive rise in sterling yen versus, as I say, that uber dovish, Bank of Japan. So where do we go from here? Well, we probably have to dip out back to not even the weekly, but the monthly. You can see the time frame now. You can see this huge move last month as everybody really got on to the fact that the Bank of England might have to hike really seriously to contain inflation, of course. So levels here are really pointing towards, well, near-term highs. Where are they? Probably around 186.34 potentially as a topside target, which is here, and then sort of 188.80 before possibly 190. So really interesting. You can see we had this dotted line here, which sort of capped the upside before, which is way down at 168. And then we had this other high here at 172.12. So, yeah, it's tough to trade. You can see on the monthly, we are overbought on the RSI. We're overbought on the weekly RSI as well. But of course, momentum is strong. So just bear with me. 183.75 was the high. 183.87 was the high last week. So potentially that is initial resistance. But we push above that, then yeah, round numbers for us before those numbers that I just mentioned. If we do slow up, then, well, support, last week's support is the low, I would say, at 181.68, and then probably the round number around 181 and then 180. Hopefully that's helped. in sterling yen, but yeah, amazing charts in any of the yen pairs really, because well, certainly with the euro yen, if you look at that as well, strong upside, and you can just see tracking sideways. So we'd call that bullish consolidation really before a big move higher again. We're tracking sideways, as I say, so range contraction, and then after range contraction you get range expansion, and generally that is in line with the long-term trend. So bullish consolidation, if we break the top side in say euro yen at 157.99, 158, then we're off to the races again. Let me just check sterling yen. Yeah, so break 183.87, this is the daily chart, then yeah, bullish consolidation before a move higher. But yeah, again, we are signaling overbought territory on a number of indicators. Okay, really pleased that helps. Please do, yeah, as I say, follow all our social media channels, which are here, and also the daily commentary that we publish on the website. Okay, take care out there, and we'll speak to you same time